Tuesday, March 10th, 2021, and this is one more of my series of discussions with people who are in the tax, citizenship, mobility industry. And these issues have become far more pressing in our COVID-19 world, our world of proposed wealth taxes, and a generally heightened sort of sensitivity to tax residency, citizenship, all these kinds of great things. And I'm really looking forward to today's discussion. I have as my guest Wayne Bewick, who is a partner with Trowbridge, which is a very large, well-known, competent international tax firm based, are you ready for this? This is unprecedented, down the street from me in Toronto, Canada. So he's going to be discussing these issues with us today. Welcome, Wayne. It's great to see you.
Hi, John. Good seeing you again.
All right. Well, let's, it's always interesting. There's so many moving parts to these issues. It's always a question of where to begin. And I think perhaps a good starting point would be, Wayne, do you think it's possible that the government of Canada is like spending way too much money these days?
Yes, definitely. Which means they're going to have to raise money somehow, which, as you can probably imagine, will be more taxes. So.
Yeah, well, I imagine that it's going to be absolutely horrendous because, you know, as far as I can determine, I mean, I live in Canada. As far as I can determine, Canada already has, should we say, brutally high tax rates. Would you agree with that?
Yeah, you know, when you look at Ontario with a top rate of 53.5% already, you know, and that's income at 220, which is a great income level. But, you know, with the average house price in Toronto being over $1 million, you know, it's hard enough to live. So when you lose 53.5%, you know, it bites. So.
Well, it certainly is. And not only is it, I mean, you know, you're talking about living in terms of paying your monthly bills, I think.
Yeah.
You know, how do you set aside for retirement and things like that with these kinds of tax rates?
Yeah, it's getting harder and harder, right, for people to do that. You know, a lot of people are just really trying to survive. And
you know, I guess people might say in Canada the RRSP, but the maximum allowance per year, and that's actually pretty low, isn't it? What's the maximum you can put into an RRSP every year?
You know, 28,000 a year, right? So.
And you know, I listened with great interest to your podcast, your webinar somewhere last week. I think it may have been Dubai. Mm-hmm. Maybe it was the one Peter did in the UK. But what struck me was there was some discussion about how the RRSP would compare to other countries. And I think, for example, a similar program in the UK, you could contribute far more to it. Am I right on that?
Yeah, the UK limits are much higher. I think you can get up to like £1.5 million into the pension eventually, which an RSP, unless you had some massive gains, is hard to get up to that at 28,000.
So that's really amazing because we have in Canada a situation, and I think this is important for people to focus their brains on, okay, you know, for a second, and more than a passing way. We have tax rates that are probably about as high as anywhere in the world at this point. Am I right on that?
Yeah. Once you're in the 50s, the mid 50s, you're pretty much anywhere.
Okay. We have value-added tax at 13%, which you know people need to spend to live, and that's another 13%, right?
Yep.
We have all kinds of user fees that are actually taxes. You know, that you start adding on, etc. And you know, it really seems to me that. I mean, sure, a lot of people point to the problem of Canada paying your bills on a day-to-day basis, but, you know, I think you've got a huge problem in accumulating capital for retirement. And that leads me to, you know, I'm not up on this particularly, but I don't think that the Canada pension plan and the old age security supplements are all that high, are they?
No, you know, they're not nearly enough for people to survive. So you really need to make sure you're able to build your pension and your capital. Now, if you're just living day to day and there's not much money to save, there could be some problems in the future for sure.
So, I mean, if I were to make the blanket statement, I'm just curious if you would agree or disagree. I'm going to make the following statement. When people retire, they could not live on Canada pension plan and old age security. Would you agree with that statement?
I mean, 100%. You're probably looking 14, 15,000, depending on, contributions and things like that. There's just no way you're going to be able to live on that. So you need other ways of getting money in retirement.
So the bottom line is this, and I think this needs to be said, is that, Canada maybe have a lot of great things going for it, but it's also a country where, interestingly, people absolutely positively need to take responsibility for their financial future. Yes?
100%. And I think now, especially, it's getting harder and harder, because people can't even get on the property line, on the property ladder, I guess you'd say, in Toronto, because houses are too expensive. So, whereas that would have been a good source of selling it in retirement, people aren't even able to do that as well. They're just, living kind of paycheck to paycheck. So.
Right. And of course, what many people have done over the years, I suppose, is they bought their property in Toronto many years ago, and, that's increased significantly in value. And I guess for a lot of them, what they would think in terms of is cashing out and getting that tax-free capital gain in Canada, right?
Yes.
And then taking that money and, sort of living off that capital.
Yes. They sell and maybe get a smaller house, or they just sell, move into a condo and live off the capital, right? And pay rent.
So that works unless you're a U.S. citizen living in Canada, because as I understand the U.S. tax rules, they will tax that capital gain, correct?
Yes. So if it's more than 500,000 US, if you're a joint filer, then they'll tax that excess, or if it's 250 if you're single. So, for most Canadians it works, but if you also happen to have US citizenship, then it gets a lot trickier. So.
Which really makes renunciation of U.S. citizenship for that group in Canada really a financial planning mechanism, isn't it?
Yes, because if you're going to have a massive hit, if you have no plan on being in the U.S. and you're getting no benefit from the U.S. citizenship, then why would you keep it if you're going to have a massive tax bill on a home that wouldn't be taxed in Canada? So.
Or to put it another way, the circumstance of U.S. citizenship for tax compliant U.S. citizens in Canada may be at the cost of not being able to have a rational retirement plan.
Yes, for sure. These are some things, and a lot of times when we see with citizens and U.S. citizens in Canada, they don't think about the potential tax on their home, because they're just thinking from a Canadian angle, and so hopefully you can speak to them before they do something. But if they sell and it's too late, and they face this tax bill. So.
Well, I mean, that's one of the problems of having to live such a frenzied life where, people are always under such pressure. But I don't want to make this the focus of our discussion, but since we've introduced the whole U.S. citizenship problem, probably we should add to our discussion things like TFSAs and, et cetera, are subject to U.S. taxation, right?
Yeah. So besides the tax on a potential sale of a home, there's so many other punitive things. Never mind the compliance costs per year, which could be thousands. Certain assets like TFSAs are taxed on the U.S. tax return. Even if you had a gain on the currency of your mortgage when you remortgage, that could be create a tax.
That's actually a great point. In Canada, we tend to think of the issue as the buying and selling of a house, but from a U.S. perspective, there's always two transactions. Well, if you have a mortgage, there's always two transactions going on, aren't there?
Yeah, and I mean, we had one case for a client in the UK. He bought a property when the exchange rate was 2 to 1. So the U.S. debt was $1 million, and then he remortgaged at 170, and it was $850, and there's $150,000 gain, even though the property didn't move in value, and it created $150,000 U.S. gain. And so, I mean, that's
without receiving any money, right? Without actually even receiving.
And the mortgage was in pounds. Like, there was no U.S. transaction. So that's another thing that people don't realize, which is just completely unfair. Because of course, if it was a loss, you wouldn't get the benefit. So.
Well, yeah, of course, because it's personal property. I mean, these rules they're shocking in their depravity. I mean, I almost I've come to think of these as, if we could make a new phrase, tax atrocities. Or
that one is just
incredible.
It's just so unfair, so ridiculous. When there's no real gain, the property hasn't done anything of value, and you're living in the UK or Canada, and they try to tax. I mean, that's a monstrosity. You're right.
Well, these things seem to be part of a series of U.S. taxes that apply disproportionately to Americans abroad that are based on no realization event, right? Nobody
Yes.
ever got any money, of which, things like the shocking transition tax, 3 years ago. Imagine just, as you know, in Canada, people use small business corporations as pensions, right? We've talked about the necessity of planning for your retirement. And they come in and say, well, we want, what was it, 17.54, without any money to pay this. I mean, it's just, it's shocking.
That was another one, like you say, people use the corporation to save for their retirement. That's what their plan is. They planned for years for this, and all of a sudden, in one fell swoop, the transition tax comes in, and people get hit with massive tax bills, and they didn't even have time to plan. It was just like retroactive to whatever the date was. And
well, it was retroactive by ambush. It was a drive-by retroactive shooting. Was what it was.
And that's it, because otherwise, we could have paid dividends at a Canadian corp, which would have created earlier tax, which isn't right, but at least you could have avoided double tax. So that was just completely unfair. I mean, when you throw in the Canadian tax rate of money coming out of the corp and then throw on another, 17.5%, it's.
Well, I mean, it would force a lot of people to liquidate the company.
Yeah.
But the thing about it is, I mean, it's gutting their retirement plan in Canada. Now, I read either listened to or read a very interesting, we're a very interesting issue that in retrospect is so simple, but I never really thought about before. We talk about people dying in Canada. Let's say you have an RRSP, right? So that's before tax money.
Mm-hmm.
I gather that there are circumstances, unless it's passed over to a spouse or something, I gather there are circumstances where the death of the person would mean the distribution of the RRSP, right, and making it taxable.
Yes. So that's one of the bad parts about it. If you have a big amount and it all gets, when you die or something, there's a deemed disposition, so it all gets taxed.
And it seems to me, though, Wayne, that's the argument. Sometimes the obvious eludes you, until you see it, until somebody hits you over the head. That's really why the TFSA is better, isn't it? Because, there's no possibility of, when that money comes out, you're not paying tax on it,
right? Yes.
Am I right on that?
Yeah, typically. I mean, the limit's only 6,000 in TFSA, so it's still pretty minor. But if you put into your RSP and you're only getting a 30% deduction because you're in a lower bracket when you make the contributions, and all of a sudden you get taxed at everything at 53.5, it's kind of takes away a bit of the.
Yeah, no, absolutely, it certainly does. But I mean, this is becoming increasingly obvious to me that there's too much discussion of taxes and not enough about financial planning.
Yeah.
And the taxes themselves are. Really just, an aspect, I think, of the financial planning, and certainly not the whole thing. But, the way the U.S. taxes the TFSA, is another problem for, Americans living in Canada or dual citizens living in Canada or something like that. And, since we're so deep into this already, you would know that, people say, well, why don't you just renounce? And, the answer is that, if your net worth is over $2 million US, then they're going to hit you with these exit taxes as well. And, the shocking part of it is, or one shocking aspect of it is that, that would, if you're a covered expatriate, meaning net worth over $2 million, the commuted value of your pension is included as full income and subject to taxation, right?
Yeah, and that sometimes handcuffs people, right? You have this pension, which again is your retirement, it's your savings plan, and if you're worth more than $2 million, which again, a house in Toronto and a pension, it's not that hard, right, anymore.
No, it's not hard at all. I read the papers. It appears to me that the average house price in Toronto for a detached house is now not only north of $1 million, but possibly significantly north of $1 million.
Mm-hmm. Yeah.
And then, if you have a pension from 25 or 30 years, I mean, you could be extremely cash poor, really suffering under these oppressive extraterritorial tax policies and be unable to renounce. because of these problems. So I think that, one message that I would like to throw in here is that those whose net worth is below 2 million US dollars, I really think you should consider renunciation before you recover expatriate. Would you agree with that?
Yeah, 100%. I mean, that's really the key because it gets so much harder and potentially so much more costly once you're over that.
Oh,
So,
yeah, absolutely. But it's funny, you can't get people to pay attention until the fire started.
yeah.
And this is a problem that, appears in all kinds of interesting ways. One of is, we talk about, for example, as in Canada, it's common for spouses to, each own 50% of the property. But, if the Canadian spouse were to predecease the American spouse, just through inheritance, you can get yourself over 2 million, right?
Yeah, yeah. I know that's why there's other planning that people don't think about even before, right? Just especially if you're just Canadian, you're living in Canada, and the U.S. citizenship is an afterthought, which you see all the time, and so do I, right? That's the problem. Is it can't be an afterthought. You always have to be thinking about it.
No, and I think that for a lot of these people, I mean, the message they need to understand is that U.S. citizenship could actually be a bar to the kind of retirement, that you're expecting you're going to get. And secondly, it's so problematic that I think that the contemplation of renouncing U.S. citizenship is probably, a financial planning tool.
Yeah,
for a lot of
100%, because it could be the thing that derails your whole retirement plan.
Yeah.
Very quickly. So.
But anyway, we're enough on the U.S. situation. It seems to me that everybody, whether you're a U.S. citizen or not in Canada, has got the problem of the retirement planning. And I could imagine, these governments, it's always interesting how they sell this stuff. Oh, we're going to go after the rich. There's only a small number of people affected by this. And right now, the gain on a principal residence is tax-free. So I could imagine a situation where that could change. They'll say, well, damn, these people in Toronto and Vancouver, why should they get this tax-free capital gain just because their properties have gone up more than other people's properties? Maybe we should limit, the amount of the tax-free gain, or maybe we should get rid of it, or maybe we should, as an introductory thing, why don't we increase the amount of the gain that's included in income? What do you think? Do you think these are possibilities?
I 100% think they're possibilities. I think your point on, maybe taxing houses in Toronto and Vancouver, I think the principal residence exemption is ingrained in Canadians. So I don't think you would do it, but I think if you went something to the U.S. system, like you said, okay, the first 250,000 is tax-free, where that, with things that have happened in Alberta, that's not gonna, not affect many people in Alberta, but you're gonna get a lot of people in Toronto and Vancouver, and the sentiment towards these people that have made a lot of money on their principal residence is not going to be favorable. So I think, I could see that very much happening. Not a full any gains tax, but some limit over a certain amount.
Well, I think probably as a starting point, what I've come to see about politics and making laws over the years is that what you do is you begin by demonizing a certain group of people. Mm-hmm. Then what you do is you write a law that at least initially appears to only apply to those groups of people. Yeah. And we see this south of the border last week. I don't want to get into this in a big way, but Senator Warren, has proposed this wealth tax thing, which is it's just shocking in its depravity. Mm-hmm. And so what she's done is she's created the cap. By the way, according to Forbes, her net worth is $12 million from mostly pension funds. Apparently, the teaching business pays well. Okay, but of course, it doesn't apply to her because she's not an ultra millionaire. Right? Yeah. You have to have 50 million plus. Well, I guarantee you that 50 million plus is going to be eroded by inflation. There's nothing in it that indexes it. B, they're just going to say, well, it's not fair that people with only 50 million should be subjected. Why shouldn't everybody be subjected to this? Once they get it in place. So, this is dangerous stuff. cost of living in these first world democracies is very high, isn't it, from a tax point of view?
It is. Yeah, it is. And, it even makes me wonder whether, again, you hit the top rate in Toronto in Ontario, sorry, at 220,000. 220,000 in Toronto doesn't get you as far as, say, 220,000 in Cornwall. It's almost like, I mean, it would make it complicated, but, you'd have to have an index for different places as well to make it a little bit more fair. So, I don't know.
Do you realize, thinking about this problem, that if you're living in Toronto, and if you're an American citizen living in Toronto, you're probably subjected to the highest and most brutal tax regimes in combination that exist anywhere in the world.
Yeah. I mean, yeah, it could easily get up to, 60%, depending, especially when you throw in some net investment tax, which is incredible at 3.8% on investment income as well. You throw that in, and certain incomes are going to be taxed at 57, 58%,
Well, it's not a surprise to me that, at least it seems to me, there's a lot more discussion about people leaving Canada, for these reasons, particularly, I don't know so much about people who are already retired, but, they're kind of used to it. But for people who, see large capital growth in their businesses, over a period of 20 years or something, you're talking to a lot of people, in the business you're in. Are you finding more frequent discussion of people wanting to leave Canada?
For sure, especially now, because I think business owners and anyone are really afraid that the capital gains rate is going to go up, and so they want to get out beforehand. And so we were just talking to someone who's expecting a very large gain, and what their planning is they moved to the UK. So there's a deemed sale on the date now, and then when you're living in the UK, if you don't remit the money to the UK, they don't tax it. So you freeze the value now, and it's not going to be taxed in the future. And so if you're expecting a big gain, it for sure get out. So or people even that can work remotely are just going to Cayman or Bermuda and paying zero tax. Because they're kind of, I think, fed up, and they can be mobile. So.
Well, I think that's right. And, I keep coming back to this whole, spending binge on this COVID thing. I mean, somebody's got to pay for this. And, in these democracies, there's no question they're going to be going after the people who they perceive as somehow, unjustly having an extra buck in their pocket to buy a cup of coffee.
Yep.
It's as though, the only morally upright people in the world left are those who have nothing, only debts.
Yeah.
Trying to live off Canada pension plan or something like that. So, I mean, as a matter of survival, I think that there are going to be a lot of people who are going to want out of Canada.
Yeah.
And then you add this, I can't help but to think that the way the COVID thing has been handled here, with small businesses being, forced to shut down, when these large businesses were, I feel far less safe in a Walmart than I do in the local shop.
Yeah, that was so ridiculous. Why would you kill all the small businesses that way and throw everyone into a Walmart?
It's shocking. But I mean, I think this is another reason that we have the taxes, but I think that recent events have probably called in the extent to which small business people can trust that government's going to, allow a reasonable climate for them to even exist in.
And this actually kind of goes back to, the attack on small businesses a few years ago, where they got rid of income splitting and a bunch of the benefits. And those were in places for things like this, to protect, small businesses when things go bad. And now they've gone bad, and people don't have as much backup as they would have. So,
yeah.
So.
Well, this is very, very interesting. Very interesting. And my sense of this is that more and more people are going to be thinking about this. I've started to get sort of messages from, emails from people in different parts of the world who are wanting, to move, or they're wanting renunciation of U.S. citizenship. And my sense of it is that it's for reasons that are beyond tax, at this point, that it's just, a general sort of, feel of unease. Let's talk about leaving Canada. Um, I'm used to saying you do not leave the land of the free for free.
Yeah.
We can talk about that separately, but let's not kid ourselves. Canada has departure taxes. You can't just leave. You want to take us through a bit of that, at least the highlights?
Yeah, so it's interesting. The whole departure tax regime in Canada, I actually find to be quite fair. Surprising. I know this is hard, especially, and maybe because I was comparing a lot of things to the US and the US.
Well, all you have to do is compare to the US exit tax, and anything looks fair, Wayne.
Yeah. So, I mean,
But leaving the US aside for a minute.
Okay, yeah. So departure tax is basically, when you leave Canada, it's the tax you pay when you leave, right? And so, for example, say you bought a stock for $100 and it's worth 1,000 now. Canada's going to want to tax the gain that happened while you're in Canada, so you'd pay tax on that $900 gain. So that's really what departure tax is. But the good thing is there's no departure tax on pensions. There's no departure tax on your principal residence. So you can leave and not be subject to a massive tax hit. And even the departure tax, you can post security and only pay it when you sell the asset. So
I know somebody who did that actually.
So, I think, Canada wanting to tax gains that happen while they're here, I think that's kind of fair. And then they just leave you out of the system. And then you're only taxed on Canadian income, dividends from Canadian companies or Canadian rental property. So, leaving Canada is to me is kind of a fair way of being taxed.
Okay. So 30,000 foot view of this would be the purpose of the departure tax is to capture the gains that accrued while you were a tax resident of Canada. Number one. Number two, are exemptions for pensions, which is, I think, key. All right. And number three, I haven't looked at this for a long time, but my impression of this is that it does not apply to things that remain Canadian source.
So Canadian property, like if you had a house in Canada, that wouldn't be subject to.
Because they still have control over that. It would be applied to shares in Canadian controlled private corporations, I gather.
Yeah, that you would have the deemed sale of that. That changed a few years ago. So there would be a deemed sale, which could be beneficial because then any future gain wouldn't be taxed. So
it'd be a way of essentially prepaying the tax at existing rate. So it is sort of like an estate freeze.
Yeah, it's exactly like that. So we've had situations where people, their company now is worth $1 million, but they know in 3-4 years it's going to be 10 million. Yeah. And so they leave and go somewhere that doesn't tax it, and they basically frozen the value. So
for Canadian tax purposes.
Yeah, for Canadian tax purposes. So
yeah, that is interesting. So it's actually it's really like the death tax. It's not a death tax. It's really like the deemed disposition of assets.
Yeah, it's exactly that. Although on death, if you had RSPs and things like that, they would be subject to taxation if they weren't.
RSPs, pensions, and that there is some sort of rollover provision for the spouse.
Yes.
On death.
On death, yeah.
Okay. All right. So, listening to you describe this both today and I listened with great interest. It was really a great presentation you did last week. Trying to be as simple-minded as I can about this. If you had the flexibility, it would seem to me a question that you might ask would be this: is it worth, by leaving Canada, to prepay tax on all this stuff will eventually be due to prepaid at lower rates?
Yeah, I mean 100%, especially because you could defer paying it until you actually sell, so you just crystallize it. So it may make sense to do that.
Mm-hmm. Now, there are also some rules which I'm aware of that are not really fluent with. If you then came back to Canada, you can unwind this tax, and what happens then?
Yeah, so it's called the unwinding provisions. So you kind of roll it back to as if you didn't leave. So, and there's various ways you can do it. So there are ways of unwinding the tax so that you don't have to pay it again until you sell it. So that's why a lot of times people won't pay the tax. They'll post security, and then if they do come back, they just unwind it and they just go on their merry way.
Yeah. Well, another interesting thing, although not directly related, I think contextually related, which I've started to see more and more of, is Canadians who move to the United States for work, sever tax residency in Canada. Their wealth has increased a good deal in the United States. And before they become long-term residents, they sever tax residency in the United States, move back to Canada, and basically escape U.S. taxation on their gain because they were never sold. In other words, if they haven't met the 8 out of 15 year test, they're not subject to the U.S. exit tax regime. So, I mean, I've seen people, avoid, really substantial, taxes by sort of leveraging, those two ideas, because when they come back to Canada, of course, they could either unwind or they don't unwind. I guess if they don't unwind, they just bring their assets in at fair market value, right?
Yeah, no, and we do that all the time too with people. Say your company's worth $1 million now, and you're a Canadian company, but you have some office or some work in the U.S. The value is now $1 million. You move to the U.S. You don't become a long-term resident or anything like that, and you move back to Canada 5 years later. The value is $10 million. The U.S. doesn't tax it, and Canada,
it's incredible. It's absolutely incredible. And these are such simple concepts. So, Wayne, surely it can't be true that you help people minimize taxation.
The Canadian system says you're allowed to put your tax affairs in the most efficient manner.
And Wayne's the man on that. Absolutely. Okay, Mr. Tax Efficiency. Yeah, that's really, really interesting.
Yeah.
So people, obviously, citizenship planning, second residence, these are all now parts, I think, of estate planning, because of the extent to which they can impact on your ability to even survive in retirement. Do you find that this is only part? Are there other reasons why people are leaving Canada? Or, what's your general experience of this?
It's weird because people sometimes, I've talked to people and they find like the 53.5% tax actually very demotivating.
It is. I know people in their 50s who just stopped working for that reason. They just don't even bother. They have enough capital to live modestly, and that's it.
Yeah, they're just like, why am I going to work when well more than half ends up going away, right? So you do see people leave for that reason as well. They're demotivated, and now it's a little bit easier. This COVID world's opened things up for people working remotely. So I think, you're seeing more and more of that, especially people are really planning now again with expectations that taxes are going to go up. So,
Yeah. Very, very interesting. And how do they, are they generally, are you finding it's any particular kind of person? What if you got a young family? Canada certainly doesn't have the worst school system in that. Are there people who are happy to live with these problems just because of the general quality of education and healthcare in Canada? Or do you see a lot of people saying that's not a good enough incentive?
I think a lot of people that are still very comfortable with the Canadian system and they don't want to risk it, for their families. But people that are, I think, a bit more adventurous, there's a lot of really great international schools out there,
Sure.
Sure
there are.
That you can go to and get different experiences and meeting people around the world. So, I think it depends on the type of person you are, but I think more and more people are looking at various places.
Mm-hmm. And what about on the issue of citizenship? I think that, Canadian citizenship is, to the extent that we talk about good citizenships and bad citizenships, is a very, very good citizenship. But there are a lot of people who are entitled to other citizenships, either through lineage or by investment. Do you talk with people about that issue particularly? If somebody were to say, oh my God, I have a grandparent in Ireland, would you immediately say, well, you got to go out and get that Irish citizenship then?
We typically would. I would typically tell them to speak to, some international immigration person in terms of that. But because the U.S. and Eritrea, I think, or Eritrea, however you say it, are the only ones that tax citizenship, there's typically, no negative in having, I have a UK passport, so there's no negative in having another passport, right? Typically. So, you want to make sure in each jurisdiction, but a lot of times it can help. So.
Mm-hmm.
So.
All right. Well, let me ask you this as we sort of, we're running out of time here. We can pick this up again soon. But given the reality of where things are today, where do you see life in Canada from a tax, financial planning, and retirement perspective, say 10 years, say 15 years down the road? What would your expectation be?
I don't know. I think at some point they're going to have to realize that keeping the rates so high is actually costing them more money than it's raising, no matter how good it might look politically. So I think they're going to have to do something like that. And then I think there's going to be a lot of issues with financial planning and cost of living, in the bigger cities that is really going to have to be addressed. Kind of how we talked about it at the beginning with, people, I think that's going to have to be a fundamental shift in figuring out ways for more affordability and other ways for people to save for their retirement.
Here's how I sort of see Canada, and I'd be interested what you think of my perception of it. I think that Canada is probably a reasonable choice if you have money and if your goal is to preserve the money you have. Mm-hmm. If you don't have money, I don't think it's a good immigration destination for the reasons that we're talking about. Does that make sense to you?
You know what, I 100% agree. And we've dealt with a lot of teachers and people that have moved to, the Middle East where there's zero tax, and they might go there and make 50 or 60,000 a year US, completely tax free, and the housing is paid for, and they can save, one spouse's salary, say. So they're saving 50,000 US a year. Whereas, two teachers living in Canada, or Toronto, there's no way they're coming anywhere close to that. So, you have to go abroad to try to save the money. But if you already have the money, then fine.
Yeah, well, of course, the teaching thing is very interesting because I work with so many, teachers on expatriation. But man, those pensions are unreal.
Yeah.
They get. There's nothing like it as far as I can see. Yeah, interesting. Listen, Wayne, this has been a great discussion. I want to pick this up with you again. We've covered a lot of different topics. If you were to end this by giving, people in Canada who, face it. At this point, a lot of people it's not that they're in serious trouble, but they are struggling to map out and preserve their futures, I think. What would be some advice that you would give them? Something simple.
No, I would think about it, if you have an itch and you have a little bit of adventure in you, then consider, looking at other opportunities around the world, because it could be in the long term quite beneficial for the whole family.
A lot of people can leave and they don't have enough, their asset level is such they wouldn't be subject to the departure taxes anyway.
Yeah, most aren't, right? Because they don't have enough assets outside of RSPs and stuff.
That's right, yeah. Yeah. Very, very interesting. All right, well, this has been great. Now, again, this is Wayne Bewick, who actually, at this point, I can safely say I've known, I think, for many years.
Yep.
Who is a partner with Trowbridge International Tax in Toronto, which is a great firm. And his coordinates, or maybe I'll let you give our listeners the coordinates, Wayne. How would they get in touch with you?
Yeah, email is good. wayne.bewick@trowbridge, TROW,
All right, next time, let's talk about the global mobility of pensions. Are you up for that one?
Yeah, that's always a fun one, and interesting now with so many remote workers and all that. So.
Oh my God! Oh, the whole tax rate on that. Yeah, it's incredible stuff for sure.
Yeah.
All right. Well, this has been good. So we'll stop this discussion and look forward to picking up another one very soon. Thanks, Wayne.
All right, John. Always good chatting.